IAS 16 paragraph 29 allows a choice of two methods for measuring assets, the cost model and the revaluation model. Let's start with the cost model. The carrying amount of an asset under the cost model would be calculated as costs less accumulated depreciation and impairment. For example, at the beginning of the year, Alex, a professional baker, purchased a new oven at a cost of $4,000. The oven is depreciated over 8 years on a straight line basis, and it has $800 residual value. In year 5, the oven had a revalued amount of $3,000. If Alex uses the cost model, what is the journal entry for the recognition of depreciation each year, and what will be the carrying amount of the oven at the end of year 5? Depreciation is calculated by dividing cost minus the residual value over the asset's useful life. $4,000 cost less $800 residual value equals $3,200. This divided by the 8-year useful life equals an annual depreciation of $400 every year. The journal entry would be to debit depreciation expense in profit and loss and credit accumulated depreciation, which is the contra asset. The carrying amount of the oven over the 8-year period would decrease by $400 every year. Remember, at the end of 8 years, the oven would not decrease to zero, but rather to its residual value of $800. The oven had a revalued amount of $3,000 in year 5. However, Alex uses the cost model, and so the oven does not get adjusted by this revaluation. $2,000 will be the carrying amount at the end of year 5. We can also use the carrying amount formula to calculate this. We know that the cost is $4,000. Accumulated depreciation would be calculated as the annual depreciation multiplied by 5 years, which is $2,000. There was no impairment indicated. $2,000 is the carrying amount. Now let's look at the revaluation model. The carrying amount under the revaluation model is calculated as the fair value minus subsequent accumulated depreciation and subsequent impairment losses. In terms of IAS 16 paragraph 39, if the revaluation results in an increase in the carrying amount of an asset, the gain should be recognized in other comprehensive income. IAS 16 paragraph 40 states that if there is a decrease in the carrying amount due to a revaluation adjustment, the loss must be recognized in profit and loss. If Alex uses the revaluation model, what is the journal entry to record the revaluation in year 5? The carrying amount in year 5 is $2,000. To get to the $3,000 revalued amount, there is an increase of $1,000. The journal entry is to debit assets with $1,000 and credit revaluation surplus, which is a gain through other comprehensive income. IAS 16 paragraph 39 and 40 also contain exceptions to the general rule. Prior to recognizing a gain in other comprehensive income, the entity has to consider if there was a loss recognized in prior years. The gain should then be allocated to profit and loss to the extent that it reverses these losses before it can recognize the remainder in other comprehensive income. So when there is a revaluation gain, you first need to consider if there were any revaluation losses that were recognized in prior years. If there were, then the exception applies, which requires you to first recognize the gain in profit and loss until the previous losses were reversed, and then to recognize the remainder in other comprehensive income. Similarly, before a loss is recognized in profit and loss, the entity has to consider if there was previously a gain recognized. The loss should then first be allocated to other comprehensive income to the extent that it reverses the prior year gain before the remainder of the loss can be recognized in profit and loss. When there is a revaluation loss, you first need to consider if there were any revaluation gains that were recognized in the prior years. If there were, then the exception applies, which requires you to first recognize the loss in other comprehensive income until the previous gains have been reversed, and then to recognize the remainder in profit and loss. At the end of year 6, the fair value of the oven decreased to $950. What will be the depreciation in year 6? And what will be the journal entry to record the revaluation at the end of year 6? Depreciation is calculated by dividing the fair value minus the residual value over the asset's remaining useful life. Note that the fair value or the new carrying amount could be used, but not cost, as this was not the first time depreciation has been calculated for this asset. $3,000 revalued less $800 residual value equals $2,200. This is divided by the 3-year remaining useful life. 8 years of total useful life minus 5 years that passed. $733 rounded off is the new depreciation in year 6. The carrying amount of the oven at the end of year 6 is $2,267, calculated as the revalued amount minus depreciation of $733. But the fair value of the oven decreased to $950. That is a loss of $1,317. IAS 16 requires the loss to be recognized through profit and loss. However, the exception to this rule is to first recognize the loss through other comprehensive income to the extent that it reverses prior gains that were recorded for the asset. A prior year gain of $1,000 was recognized through other comprehensive income. So the journal entry would be to first debit revaluation surplus in other comprehensive income with $1,000. This is in essence reversing the gain that was recognized in year 5. The remainder then gets debited as an expense through profit and loss. The asset is credited with a total decrease of $1,317. To summarize, IAS 16 allows a choice between the cost model and the revaluation model. Each model has different rules, and thus the same asset may be accounted for differently depending on the model selected by the entity.